Good afternoon, everyone. Thank you for joining us for another episode of the Blockchain Advisor. Today, I am so pleased to have our guest, Jay Pestrichelli. Jay is the Chief Investment Officer, I guess you would say, Chief Trading Officer,
Chief Trading Officer. Yep, you
Chief
got it.
Trading Officer on the YieldMax ETFs, which are insanely popular. And as a old options trader, Jay uses a lot of option strategies to enhance yield, provide larger distributions. And we're just going to have a great conversation with him, kind of one-on-one, and just find out a little bit more about what goes on behind the ETFs. And of course, Jay, you're free to just run in any direction you want.
That sounds great, Bill. Thank you.
Thanks.
Let's
Well,
get
listen,
into it.
so even though the title of the Spotify channel is the Blockchain Advisor, that's the centric of the business. But again, having always loving a good shiny object and being an investment advisor, we're looking for ways to enhance education, support investment advisors and retail clients. It's my channel. I can do whatever I want. So I wanted to have you. So that's really the story.
Well, no, I appreciate you having me on. And, for those that don't know, you have been trying to coordinate with me for quite some time, and we had some bouncing around on our end for things. So really appreciate your patience and happy to be here. Happy to kind of go through and talk about some of our funds that touch crypto, blockchain,
Mhm.
wherever you want to go with it.
Good. Well, listen, Jay, let's just start at the beginning, if you don't mind. I like to just get a little bit of personal background on the people that I interview, and that is what's your background in option trading? How did you get started in this space?
Well, it's a great question. So I started in I'll call it the brokerage business in '98. I worked at a little firm called Daytech Online. So I started in the do-it-yourselfer side. We merged with Ameritrade at the time. That was '02. Moved to Nebraska and ended up running the active trading business at Ameritrade slash TD Ameritrade for a decade. So really great job where we were able to help and empower, the individual do-it-yourself investor to really meet their financial goals. And that included things like derivatives and options and futures and Forex, along with, streaming platforms, margin, all kinds of fun stuff that do-it-yourselfer likes to have. And then I left in 2010 and started my own firm, Zega Financial, which was a registered investment advisor, an RIA. And we specialized in options-based strategies, right? So we've been doing option strategies for folks in one way or another since 2010, 2011. And that kind of led to then getting into the ETF business. I will tell you, as you know this as an advisor, there's so much complication associated with options in separately managed accounts. I'm sorry if I use the term SMA. Basically, that just stands for an individual's account that an advisor trades, right?
Mhm.
And we found that why not take strategies that people were coming to us with on individual names or individual goals and put it into an easier to adopt wrapper like an ETF. And so when there were some rules that changed over the last few years, 2019, 2020. Some rules changed around the 40 Act funds, which is what an ETF is, that allowed us to run some options-based strategies like this in an ETF wrapper. And so, this is just one of those things that, being able to get this kind of a little more sophisticated strategy out to the masses makes it so much easier than folks having to find you as an advisor, open an account, all the paperwork. We get the wonderful option disclosure document every year from our regulators, and right, it's scary and there's margin. Sometimes it's easier to buy an ETF, and so that's really how we got to the place where we are with YieldMax, which is an options based series of ETFs. I think we'll talk about a few of them today, but the idea here is if you could think of it, we could probably do it better with options. And this is, a fairly this brand started with a fairly simple strategy of covered calls on stock like Tesla, right? And then that kind of built up into the family of today, which I think it's probably over 40, close to 40 individual ETFs in the YieldMax family. Again, all of them options based. Some of them have a pretty fairly limited amount of strategy. Some of them have a wider range of tactics that we can utilize. So, we do what we can here
Right.
to try to create unique products and try to be really try to give investors an answer to a problem that you couldn't otherwise find without finding somebody specialized like yourself.
And where did you actually cut your teeth though in the world of options? Because
Yeah, that
learning
was
it
it. It was in the
actually that
do-it-yourself side, right? It was the Daytech is like Daytech and Ameritrade world, right? Like we built an education business there around options. We really so let's think so this I'm gonna date myself a little bit, but like in 98, 99, options weren't like an obvious available product on a lot of platforms, right?
right.
So,
Yeah,
we built the offering at Daytech for options from scratch, right? And then um you just as you just kind of start in that space, the beauty of options are once you get hooked, there's like, oh, there's always something new to learn, always a new tactic, always another combination. I think, the education material that you can get from the OIC is like 47 option strategies. But like, look, you could even do different things within those, right? So
right.
it just kind of grew there. So it came from educating people about options, building option products, and then running an advisory business with hundreds of millions of dollars within client accounts that were all options-based strategies, and
Sure.
then that grew to here. So I don't know. I guess I've just been living them for 25 years.
So what was your core strategy for getting up to 100 million or 200 million? Because now I think I mean that because you still had a great deal of assets under management even before the changes in the world of ETFs, right? In 19 and 20,
Sure.
19 and 2020. What was your growth strategy there?
So there's three things you could really do with options, right? You can use them for income, selling premium. You could use them for protection, meaning hedging, buying puts or limiting, risk with positions like spreads, or you could speculate, right? So we would put out products that hit on one of those three things. Our main, believe it or not, the main or my first really kind of, I'll say, successful strategy was hedging, right? Long equity with which now there's so many of these in the buffered world, but this is pre-buffered. Long equities with the long put or long put spread for protection. So hedged equity. And that kind of grew into, okay, hedged equity with income, which is known as a collar in a lot of circles. So,
Sure.
it just kind of evolved from there. The other thing that we did that was fairly successful was high probability option strategies, where you're selling deep, deep, deep out of the money, options that they have a low chance of the market ever, putting those into trouble. By the way, if those ever do get in trouble, it gets ugly in a hurry,
Sure
right?
does.
Selling deep out of the money put spreads. But like all of those things, it was really along those lines of positioning income protection. We never really did the speculative thing as an advisor,
Mhm.
right? You didn't want to be that place where people came to do quick bets and leave, right? You're looking for a longer term planning relationship. However, in the ETF world, let's face it, there is a wave of adoption on leveraged single names strategies and inverse up down to right multiples. So I think it's interesting that you can now do those things because the individual investor is the one to choose when they want to get in and out. When you're
Mhm.
running an advised strategy, it's not usually all that tactical or handsy. Even though you may run a strategy that is active, people like, oh no, I want to get out of the market right now. I think that hits, or oh, I want to switch from bullish to bearish, right?
Right.
That's a little harder to do in an advised relationship, but in an ETF, that's much easier to do. So yeah, those three things, I would say that's how, we started with hedging and income through high probability option selling, but speculation is obviously picking up as well.
And would you say when you were dealing more with individual advisors on a separate managed account level, would you agree or disagree that it seemed like when the market was getting killed and really tanking, that you had to be you had to trade in a contrarian manner against your clients because they were calling up panicking near the bottom and always wanted you to take more risk near the top. And I don't know if you would agree with that, but
That is 100% true,
I see
right?
that
Yeah,
on my side. So I hate to
yeah.
say it, my clients hate it when I say it, but you're my indicator. I don't need Forbes or Wall Street Journal.
Yeah, right. You probably have a handful of clients when they call, it's the first sign of some volatility. And then the second wave of clients call, okay, now you know the bottom is in, right? Like it's funny. It's that by the way, that's not a dig on the individual investors. It's an look, money could be emotional. Like
Yeah.
it's you have to remove that from the equation. And when you're in that advisor seat, it's like, look, I've seen this three or four times. I'm gonna give you a perfect example. Um, August 5th of 2024 the Japanese yen currency trade, right, unwound to, to the VIX spiking to the second highest level it's
Market
ever
was down
been.
like 1,200 that day or something.
Yeah, and look, yes, okay, so you had this little wiggle in the markets, and if you were a seller on that day, you have now just missed out on an amazing run because why? Because the market was down. You probably didn't, most people probably don't even understand why technically that had to kind of reset itself quickly and then undo itself. But guess what? We saw that play out multiple times in the past, especially when there's a currency little juxtaposition, like
Mhm.
justification. So like 2015, there was another August, by the way. August is a weird month, right? It could be nasty or it could be really boring. August of 2015, if you remember, the Chinese devalued their currency. S&P sold off 11% in 3 days, and people like were freaking out. But guess what? It was over after 3 days, and everything kind of leveled right back to where it was before it happened. So just having some of that experience, but look, when you're not living it every day,
Yeah.
all of a sudden these events seem really like, oh my gosh, should I be selling? The market's down 4%. Yeah, it closed down only 1% that day, and 3 days later, everything was back to normal. You're right that emotion gets a hold of people, and it's super normal.
Mhm.
And look, you could be wrong or right, but at least you could point to, hey, this has happened 3 times before. Let me show you what happened a week after, a month after, a year after. I don't know what's going to happen,
Right.
but generally this is okay, right? So it's you're right. It's taking emotion out of it and having the more of a a planned approach. Definitely.
And we become more stoic, I think, as time goes on. The longer you've been in, you don't let these shakeouts really
Yeah, it doesn't
get you.
show, but there's plenty of gray hair in here
Yeah,
for me,
well,
right? Like I've been
mine
through a
does.
few of these things.
So Jay, in terms of you said some interesting data came out or changes in the world of ETF to 40 Act in 2019 and 2020. And I did watch one of your videos on YouTube, and I think it had to do with the way an exchange traded fund was prohibited from owning more than 5% or 25% of an individual security. And you guys, is that what you were talking about? How?
So that's look, I am not a regulatory 40 Act lawyer, right? So I don't want to quote any regulatory statutes, but what I would say, so yes, so previously, right, you look at ETFs were more like, passive, index based. There's lots of diversification rules associated with that. And so as things, I think it was 18F4 might have been the statute that kind of allowed you just start to do some things where you could be concentrated with a handful of things like cash or treasuries,
Mhm.
right? And then as long as you followed a couple other rules, whereas you're not more than 25% in an individual issuer, meaning an individual stock, then you're okay to be in a fund. Well, with options, you can create 100% exposure, feel like you're fully invested, but only use 20, 15, depending on the volatility of the stock, percent of the account, right? 15%, 20% of an account to make it feel like you're 100% long. And so all of a sudden, you've got treasuries as collateral, you've got a synthetic long position, which is a long call short put kind of a deal or whatever combination you want. And as
Mhm.
long as that position didn't exceed 25%, you could now be in a long portfolio of a single stock, right? So you got to kind of meet those rules associated with the
Mhm.
the position limits. And next thing you know, you're right. You could have a single stock as an ETF with a single stock only. And it previously you'd have to kind of use different vehicles, right? Notes and things like that.
So ultimately, so what I hear you saying is even today, if I were to pick any one of the YieldMax ETFs, you're saying that you're 76% long treasuries and the other 24% is synthetic exposure to a stock, and then you're doing the call writing strategies on that. Is
Yeah, if
that?
you were to look at the market value of the option positions, right, in a
Mhm.
single stock, every it's the rule is like every quarter you have to kind of meet that test, right? So you
Gotcha.
may drift above it, during the quarter. But yeah, if you took a look at it, we normally are more like 90% treasuries, right?
Really?
Because
Wow.
yeah, well, because you're doing things like selling that put, which generates cash, so you use that also. So
Mhm.
yeah, usually you want to have as much as you can in collateral to pay for those things. But you're right. It looks like a treasury fund, right? Because hey, you're 90% treasuries.
Mhm.
There's this little option thing with a long call and a short put that was only worth 10% of the portfolio. I wonder what that does. Yeah, that's 100% exposure. You got it
Gotcha,
right.
gotcha. And so, are you at all concerned about maybe a decline in interest rates, over the next year or like the next cycle with things slowing down? If treasuries go from 4.5-ish to 290 or 260? Like, is that, I mean, I know that your option prices are going to change a little bit with that, but does that
You
worry you at
got it.
all?
That's you nailed it, right? It won't really matter because so one thing will change the SEC yield, which is like kind of the the definition of yield based on what you get from like bond payments and actual yield versus option premium payments and distributions. That will drop, but it will not change the performance of the fund because like you just said, the options adjust, right? The market's not going to let you create a synthetic position where you have 100% exposure without charging you the same cost to carry, right? So there's this concept of cost of carry where if I put that position on, it usually costs me the risk-free rate. Or if I'm putting on a 2 month or 3 month trade, let's say that's expiration, they'll charge me for that position the 3 month treasury rate. So the treasury is really just offsetting the cost of the option combo,
Right.
but the market won't let you, like there's efficiencies in the marketplace. You can't just put on a combo for nothing because guess what? The other side of whoever's taking the other side of your position had to actually give up what they were earning in treasuries to put up the collateral to be on
Sure.
the other side of your trade. So the market will neutralize that, right? Today we're paying more for combos than say we would have in 2020, but as rates go down and treasuries go down, so will the cost
Sure.
to put on those option positions.
So
So it should be
the combo or the synthetic strategy for people who are listening that are not familiar with options, that is you can either own 100 shares of stock of say MicroStrategies or Coinbase, or you can do something that has the exact same risk profile, and that is buy a call and sell a put of the same strike at the same expiration. That long call short put exactly mimics the risk profile of owning 100 shares of stock.
You got it. You got it 100%. And I would just say, I would add, plus the treasury then offsets the cost of that
Right.
combo or that synthetic. Now you said it. You've literally mimicked the day-to-day tick by tick move of the underlying stock. Yep.
Exactly. So with companies like MicroStrategies and maybe Coinbase, not so much with the JP Morgans and ExxonMobil, do you find that is there any kind of negotiation room with the clearing firm because you've got your treasuries that say 4.5, but maybe you have a stock that's hard to borrow or a negative carry, a negative rebate where the combo is that could really work out in your favor though, since you're not actually trading the stock. But does that interfere? Does that affect the P&L of the
Yeah,
ETFs?
look, there's a factor associated with the risk that your counterparty takes, right?
Hmm.
So let's do a little math here. Let's say you're the market maker and I'm YieldMax, right? And I say, okay, I want to, get long with the combo 100 shares of MicroStrategy. You now, in order for you to stay neutral, right? You've just given that to me. So I'm long, you're short.
Right.
Well, guess what? You don't want to be short MicroStrategy, right? You don't want to take market risk. So what do you have to do?
Buy
You have
stock.
to go out to the market and buy 100 shares of MicroStrategy, right?
Right.
Or you'll delta adjust. But with these, they're 100 delta, which means tick by tick. So if it's costly for you to go to the market and buy those shares of MicroStrategy, because maybe they're harder to get, or there's a wider bid-ask spread, or
Mhm.
whatever your costs are going to be, uh, in that scenario, you're going to pass that fee on to me in the options, right? So while let's say rates are, 4.5% for, the overnight cost, you may charge me 5%, right? A little more for stocks like that. Whereas a JP Morgan or an Exxon's like, you're right, really easy. Tesla, really easy. Nvidia, really easy. MicroStrategy, less easy, right?
Yeah.
To get long that. And then guess what? You have a requirement from your custodian for holding those shares of MicroStrategy, right? Okay, that's all it costs. So, like I said, there's no free lunch in the marketplace. All that stuff gets passed along
For sure.
in the trade execution.
And then just curious, like how many guys do you have working on the team? Like how big is the trade desk? How close do you sit with each
The
other?
trade team at Tidal is 25 plus, right? That's all kind of areas, right? For all the funds. So Tidal manages and trades, I should say trades close to 200 funds. It might be over 200 funds now. 30 billion of assets, right? So I think Tidal probably has, from an ETF shop perspective, the largest trading team on the street. With regards to just like the yield max and the active option strategies,
Mhm.
it's a dedicated 8 plus people.
Okay. That's really exciting.
There's a lot of people trading all day. I would tell you, I know there's somebody, Jay, how could you handle all these funds? Jay is not trading 50 funds
Right.
actively throughout the
No,
day. Like
it was
that's not,
being a trader back there. It's the best that I don't even, I can't, words can't describe how awesome that is.
Yeah, I
Um,
mean, it's my favorite job. I wish I could do it more.
I
But I
know
love doing these too, don't get me wrong.
for
But I
sure. No,
love the
same,
trading part of it, right? That's
same.
when where you are at a core.
So let me ask you this: if you can divulge this, if you had to take a snapshot, let's say the market's already closed, what's your daily decay? What's your theta in across the entire yield mix portfolio?
Oh no, we are earning theta, right, in
Right,
yield
right,
mix.
exactly. What are you collecting in theta?
Yeah. So, well, look, it's if I was to give you a mix here, okay, it's I haven't thought about that question, but I'm going to answer it in an easier way. Look at the Y Max ETF, right?
Okay.
That is the fund that kind of houses all the individual components, and look at the yield that that's kicking off. So arguably that is going to be a good representation of all of our single stock kind of bullish, covered call
Hmm.
exposure. And I think that's probably running at, 40 plus percent. I don't want to, make too many forward looking statements. Some
Sure.
weeks it's more, some it's a little less. I think then you add in like the LFGYs or the ULTIs of the world, and that will kick it up a little bit. But yeah, I mean, I think it's fair to say in general, this is a function of volatility, right? So the more volatile the market is, the
Hmm.
more we're going to earn in theta each day. But 40 to 50, probably, I won't be too far off if that's it.
Okay. I was just wondering because again, we would, as an off-floor trader, we would look at our all the Greeks, right? And we are like, well, yeah, we're collecting 2.2 million or we're collecting 1.5 million in decay. It doesn't mean you get to keep it. It just means that's theoretically what you get to receive. And
Yeah, if
so,
all things go, you're right. You don't get any money. The weird market moves like that's. You're right. What we're earning, and I guess I equated it to an annual basis. I guess you want to go by day, right? So it's 200. Let's call it. Yeah. It's 20 bips a day, maybe.
okay, thanks.
It adds up.
Next question is, how did you establish the relationship with Dorsey Wright? I understand that you guys are coming out with a few ETFs. I think it's FIVY and FIRV. I'm not sure.
It's FIVY, right, and FEAT for like
Right.
featured. So those are live today. You're right; those two are live today. Um, it came out of the idea that there's a lot of folks that would say, can't you just pick, like, do a fund that picks the ones you like the best, right? Which is, that's our skill set is not, our skill set is not picking which ETF or which underlying stock we think is going to outperform generally. With Ulti, we do that. But besides that, we're not looking at which one of our ETFs we think are going to outperform. So we said, hey, let's partner with a firm that has a great reputation for momentum trading and, their indicators that they use and let them pick from our universe of single stock ETFs which five have the most propensity to go up. Because remember, these are covered call strategies. A lot of people may not realize this, but you're still bullish when you're in a covered call strategy. Maybe not bullish, maybe not a double bullish, but you still want the underlying stock to go up. And so you want to, if you were picking which yield max you want it to be long, you want to find the one that's got the best chance of going higher. So utilizing a partnership like Dorsey Wright, we let them give us the five of our single stock tickers that have the greatest chance of going up according to their momentum indicators each month, and then we rebalance and put those into FEAT. And then for folks that say, look, I want some upside, but and I want some income, but I also want a little more upside, we do a mix where an FIVY, which is kind of more of a combined version, we're long the stock and long the YieldMax ETF. So we might be long Coinbase, COIN, but then we'll also be long a piece of CONY, which is the YieldMax coin
Sure.
version, right? So it's 60/40 is the general build of those together. And that's it. And so I think it was more around just finding a great partnership where we, look, they have a stellar reputation.
They do.
And so we thought it was, and we do a lot of work with the NASDAQ and they're associated there. So it was a good fit.
Yeah. I've been a Dorsey subscriber for about 25 years and I love what they do. I love their momentum and relative strength calculation. So when I saw that, I was really pleased about that. So, okay, I've got one more question for me myself, and then I've got a few questions from our other interested parties on Facebook and in email.
Sure.
And my question is, could you just spend a couple of minutes explaining the return of capital concept conceptually? I still don't fully understand. I get everything else except the return of capital, and I kind of get it, but I just want to hear it from you.
Yeah, so return account, I really think it's a misnomer, but that's okay. And I understand why it's called return of capital, but let's talk about our covered call strategies. I'm gonna use a very simple example, and we'll do a scenario where the market's up and a scenario where the market is down. Um, the concept of cover of return of capital is where you give back more in a distribution than you realized in your trading gains and losses. So it's a realized, and again, this is more of an accounting term, but the general gist is if you are giving money back in a distribution, but you hadn't realized that much of a gain, it gets categorized as return of capital. I mean, it feels like a lot of people are like, oh, you're just giving me back my money from the fund. And
Mhm.
I think before option strategies, that was a fair assessment, right? Let's say you had a bond fund that was earning 6% in yield, but you paid out 7%, right? As if yield to maturity was 6%, but you paid out 7, you're giving back an extra 1% than what the fund earned,
Mhm.
right? That's the base concept. With option strategies, though, because you're not always realizing your gains and losses at the same time, there will be times where your distribution gets categorized as a return of capital because it's based off of realized gains. So I'm going to give you this first example. Let's say we're long stock at $100 and we sell the 105 for $1, right?
Mhm.
And now the underlying in our synthetic combo, right, goes to 110, right? So now I'm at 110. My long stock went from 100 to 110. Great, that made $10. But the short call that I sold at the 105 is now worth a negative $5, right? I have to buy that call back for $5 at expiration, right? The difference
Mhm.
between 105 and 110. So let's say I don't touch the combo, but I realize the loss on covering that call, right?
Gotcha.
Now, I'm going to turn around and give you the dollar in the distribution, right? Because that's the idea here. I want to return what we made selling premium. So you're going to get a dollar back, and the realized losses in the fund were $5. It will look like return of capital, right? Even though the underlying has made $10 and the fund is positive, right? In that scenario, but we want that to happen in a covered call. We want the stock to go up. I want to have that appreciation, right? In that scenario, by the way, you netted $6, right? The
Mhm.
first five, and then the dollar of income from the cover call, and we'll give you back the dollar. That's how return of capital is happening on the market going up. And let me ask you a question: would you feel like, oh, you're just giving me back my own money in that scenario? No, we made a dollar selling the call.
Sure.
Here's the dollar we made. So forget about the fact it cost me $5 to get out of it. I have long stock that made that over here, but I
Mhm.
realized that loss. So that is what has happened. By the way, this has happened in covered call strategies forever. Right? If you look at one of the, much older version of a covered call strategy like a QYLD, there are years where almost all of their distributions are return of capital, right? And that's one of the global X funds. It happens with option funds because it, I haven't closed that combo yet where I made the
Sure.
10 points, but I had to cover back the $5. Now let's take the other side of that example. Market's down in that same scenario, right? Long at 100, sold the 105 for a buck. Now the market's at 90, right? Well, I'm going to make in that scenario the $1 from that covered call, right? It's going to expire worthless. I'm going to turn around and still give it to you. But the fund is down, right? So we turn around and I hand you back a dollar while the fund has experienced losses because we lost $10 on the synthetic position, but you're still getting your dividend, right? So in that
Gotcha.
scenario, that feels more like what we've heard people call NAV decay or NAV decline, but you made the dollar in the call, and the whole goal here is to earn the premium we're going to give back. So
Sure.
that is an example where, and by the way, if I had to close that long position because of whatever I'm rejiggering margin, I would have realized the loss. I'm still going to give you the dollar because that's what we earned on the short call.
Sure.
So it's unfortunate that it falls into that categorization. I don't, I'm not an accountant and I'm not the one writing the rules, but that the way the tax code is written and treats these things. But that's how this occurs almost, every month in some of our funds.
Sure. Is it permissible for you to um I don't want to use the word aggregate all the yield max positions, but could you say, well, we really knocked it out of the park in MicroStrategies this month, but we got hurt a little bit in Coinbase or JP Morgan. Let's smooth the whole P&L out, and we're going to just instead of giving 20% in MicroStrategies, we're only going to give investors like 12 or 15, and we're going to just move a little bit of that money over here so we can kind of just smooth the earnings out. Is that
Well,
probably
you
not?
can't cross fund, like I can't take Coinbase money and MicroStrategy money in the two individual funds. They're separate investment companies.
Okay,
They have their
gotcha.
own, tax IDs, 1090, W-9s, all that kind of stuff. So those are you can't, cross
Okay.
the assets between them. So look, there are some funds that don't pay all of the money they made from their realized gains or even
Mhm.
their premium selling. By the way, that I mean let's go back to the example I used before, right? You look at Global X's QILD. They're only going to pay you 1% a month. If they made more, they're going to keep the rest in the fund, right? So that has been the traditional methodology with
Sure,
covered call strategies. We thought we'd do it a little different. We said, look, if you're investing in YieldMax, as the name implies, we're going to turn around and pay out what we made from selling option premium.
sure.
If you don't like that it's reduced your position size very much, fine, feel free to reinvest it. It's what we would have done if we held on to the money anyway,
Perfect.
right? Feel free to buy more shares while it's at a lower price, dollar cost average lower, whatever it is you want to do if you want to keep your position size the same. But we're going to give you the choice to do what you want with it. I think that's one of the things that's unique about YieldMax that a lot of other funds haven't done. And it seems like the market prefers that.
Sure. Well, that's funny. That's a perfect answer and a perfect question because it's going to segue into a question by Joan Marie, who said, "Please ask Jay if he views the YieldMax ETFs individual, the ones that are individual names, should they be held long term, more than 10 years, or does he view them as a temporary income play of less than 10 years?"
Gotcha. Again, it all depends what you want to do with these. They can be an income play. They can be a growth play if you're reinvesting, right? So I think it's how you want to treat these in the portfolio. Look, I would tell you first and foremost, you have to be bullish the underlying if you're going to want to be in one of the single stocks, right? So that's your first, check. Hey, if I'm bearish Tesla or I don't think Tesla's going to do very well, don't buy Tesla, right? Because you're taking Tesla risk when you own Tesla. So I think that's your first question you want to ask. The other thing is we are picking fairly volatile stocks to create the higher than average, I'm underselling that, the higher than average distribution rates. So, right, some of our funds are distributing, on an average basis, 50, 60, 100%, right?
Right.
So you're not going to get that without taking risk, right? So there's always risk and reward are always going to be associated with each other. And you should be able to tell the riskier underlyings based off the distribution rates that we have, right?
For sure.
MicroStrategy just paid out its dividend today, or went ex-div today. It'll pay out on Friday. That's going near 100%. That's going to be volatile. So you'd have to be comfortable owning MicroStrategy for 10 years to hold MSTY for 10 years, right?
Sure.
So
Sure.
first wrap your arms around that one. And I almost think you answer your own question.
Yeah.
Can you use these for income over the long time? Yes, I absolutely. But again, it's how you want to use the funds in your portfolio. Do you think you should take out 100% of the dividends that you got paid every month? If you do, you're basically divesting your position to cash. Because we're giving you what we're earning on premium selling, you're deciding I'm going to take that cash and put it in my pocket. Should you reinvest some? Okay. If you want some growth, longer term growth, yep, you should. If you only need 4%, which is what, the old 4% rule that
Right.
Bill, really well,
For
right?
sure.
Yeah, so take out your 30 bips a month, put the rest right back into the position. Now you've got some income and you've got growth because you're compounding your shares, right?
Sure.
So I guess it's all dependent on what you want to use them for. But can you hold these for long term? Yes, absolutely. This is not I don't think these are trading vehicles, right? They're not like a leveraged single stock product. These are, designed around distributions and dividends. And you just have to first answer the question, do I want to be long Coinbase, MicroStrategy, or, whatever? We could pick a few of them out there, right? Forever? Then that's your first question to answer.
Sure. Sure. This question is from Jefferson, and he asks, why aren't they publishing the distribution percentage anymore when they announce them? I'm not sure.
Yes, it's a good question.
Okay.
Today, or I'd say yesterday, when we announced the most recent one, we included it again. So
Very
we
good.
took it out for a little while because of whatever the rules were, the approval rules of the notifications, but it is now back in. So the release we did, I think yesterday for today's distributions, that the percentages were in there.
Excellent. Thank you. This question is from Liz Ferguson. She said, please tell Jay, thank you so much for giving us great opportunities. And she has like two little hugs and kisses next to the statement. So you have some people are giving you some love. You got some
Thanks,
people
Miss
complaining
Ferguson.
about the NEV erosion. You've got other people who are sending their best wishes.
Yeah, well, thank you for that. I would say it's under like there's always there's pluses and minuses. I've had people say, "What's the catch? This seems too good to be true." If you think these are too good to be true, you don't understand the full picture. I just first off talked about the single stock risk that you're taking,
Hmm.
right? Be careful about any concentration that you're going to create. And the other side about this is realize just because you buy an ETF at this price and it has a certain rate doesn't mean you're always going to have that rate, right? Volatility will change the rate. The underlying price is going to change the rate. Realize when we, uh, touching back on the rate question, when we publish, the distribution rate, it takes this one, distribution and annualizes it, right? So if the underlying stock goes down, and then even if we're still paying out that same rate, you may get less, dollars or cents per share than you got the first month because the underlying dropped. By
Hmm.
the way, that flips the other way. You look at like Palantir, for example, or even MicroStrategy, which the fund has been doing fairly well. If the underlying goes up and you're still getting that distribution rate, your income is going to change, is going to increase as well because it's an annualized rate per month. So understanding all those dynamics, I think not everybody gets it. These are not your father's ETFs, if that
Right.
was even a thing. I'm still in the Buick line there.
Yep.
But there is some understanding and knowing how all the dynamics are working. And yep, use it for income, use it for growth, just understand the risk that you're taking.
Sure. Great. Thank you. This question is from George. George, Jay says, Jay, can you please provide a deeper dive into LFGY?
LFGY. So this is our crypto-based multi-position portfolio where we are selling options for income over, I think there's probably 20 long positions in this portfolio. So, I was thinking about pulling up the prospectus, right, to talk about this one, which is almost the easiest way to, touch base on this. But really, I would say it's an actively managed portfolio of crypto and blockchain type companies. Even holds, I believe we've got some.
I'm going to pull it
Yep,
up
we've
right
we've
now.
got
Let's
like
see.
a Bitcoin ETF in there, right? IBIT is in the portfolio as well. And we are, the portfolio tickers are fairly stable. We don't change those very often. So far, because the fund is fairly new, those have not changed. But we are actively selling options for income. And then over the top of the whole thing, we are adding in kind of a Bitcoin hedge, right? So it is a what I would call a Bitcoin catastrophic hedge. Man, that sounds like waiting for a Bitcoin catastrophe. That's not what I mean. But it's it's not expensive. It's 25% out of the money. It's just meant to buffer a significant pullback in a hurry because a
Gotcha.
lot of the performance of the individual holdings is tied to Bitcoin itself. So
Okay.
that I think that's the general gist of this. So I don't know how much a deep dive as you would want to go into here. I mean, even getting to the point of talking about positions in the portfolio, but I would tell you that this is a portfolio where we are going to be active in rolling our options with the idea of generating income. I think our distribution rate has been somewhere in the neighborhood of 60-65%. And then on top of that, we've got this, we're paying for a longer dated hedge on Bitcoin itself using an ETF. So I hope
Gotcha.
that gives a little more than cursory, but not too deep to bore everybody else.
No, no, that's great. No, I went to the Dorsey Wright website, but they did not have their database updated
Yeah,
with
this is
the.
not that one's not a Dorsey Wright. LFGY is not
Oh,
a Dorsey.
you're right.
Right,
You're
right.
right.
This is straight up YieldMax.
But that's
So
okay because generally Dorsey will still give me an idea of what's inside. I
oh, oh,
need
oh, oh, they might, right? Their
my eat
research. That's
my the
fair.
research,
Gotcha.
but I'll have to dig that up a little bit later. Maybe if I can do it with one eye and screen looking at you and one over here, I'll pull it off. Next question. This is from Michael, and he said, um, also for the MSTY, the fund runs better for the most part without the covered call strategy in place. Some funds have done better with them, some without them. Others, like, I'm not sure I understand this question. Others, like MSTY, not so much. Why don't we utilize the old way of not having a long call, which doesn't seem to
Ah, okay.
assist only in hurting the funds? Like, I disagree with that because we saw how MicroStrategies just, I mean, it went from 120 to 500 so fast. It totally
Yeah.
game stopped. And so to have those upside calls was a lifesaver, in my opinion, to have that because covered, you'd have gotten annihilated with those covered calls. But go ahead. I'll let you answer that
No,
question.
you got it. So what we're talking about here is in September, we gave ourselves the ability in the funds to not only just sell a covered call, but also sell a covered call spread, right? Which is where you're short a call and then you buy another call higher up. So what does that? So I would agree recently, if you look at the volatility of MicroStrategy, it is kind of at a 1 year low right
Yes.
now, right? So there's all sorts of things you could glean from that. I won't give advice, but man, if you wanted to speculate on MicroStrategy, this is the time to be a buyer of options versus seller of options. So what does that mean for us? So it means as we're trying to hit our target income where we're selling the calls, we're having to get a little closer, but nobody wants to get caught off guard when the pop comes on MicroStrategy, which we all know. Heck, we've even heard from Michael Saylor. He would tell you his stock is twice as volatile as Bitcoin,
Mhm.
right? And Bitcoin's got a vol of 60. So we should expect to have more implied volatility in the MicroStrategy options, but they are not right now. So you're right. It's I think the last handful of the spreads we put on, yes, it would have been better just to sell the short call, but I think it maybe it doesn't work for you three, four, five times in a row, and then when it works for you and when there's momentum, it's very helpful. There's two things that the call spread does for us. The first one is let's talk about Palantir. Right,
Mhm.
last week, Palantir came out with the earnings. We were short a call spread, and it gapped so far, it went through both of our strikes, right? We would have never have had a chance to roll up those calls overnight, right? From 4 p.m. to 9:30 the next morning, Palantir was up 20%. And it was, if we didn't have the call spreads on, we would have been capped out at, 5%. Meanwhile, the fund made 22, 23% that day, while Palantir made 28 because the call spreads were on. So
Right.
it helps you from like the surprise
Upside.
perspective.
Yeah, for sure.
Um, but where else it happens is like, let's say you take a MicroStrategy and it starts running up. Um, when you're selling calls, the idea is to earn the premium from the call that you sold. Now, we will be active and we will cover back a call when it's earned 85, 90% of its time premium, right? If I sold a call for $1 and it's trading at 7 cents, there's no reason to be in that short call anymore, right? You want to
Mhm.
get out of that. Well, that, by the way, that's the time value of that call. So that could happen if the market is up or down when there's no extrinsic or time value left in the call. Makes sense to roll them. There's no reason to be in that anymore, right? Like you asked before, how much theta do we have? When you're at a theta, that's the strategy is designed to sell theta, right? So
Mhm.
you need to move it. If you're only short the call and you have a stock like MicroStrategy, those hold on to that time premium much, much longer, right?
Yes.
But when you do a call spread, you have the other side of that spread, the long call, that may have a growing extrinsic, a growing time premium, right? So I'm going to do this. Let's say your time premium was high on the short one and was low on your long one because you just bought this thing way out of the money. You never knew what it was going to be worth, right? It wasn't worth much. Well, as the time premium goes down in your short one, because the stock is moving up, up, up through your strike, this one is going up, up, up as well, right? So I get to my neutral time decay much, much faster in a call spread. And so while it may look like, hey, you lost money in the short, that long call again, guys, what are you doing? Stop buying the long call. Really, what we've done is it's now allowed us to unlock that position and sell a new call spread again much, much sooner versus letting a stock like MicroStrategy run up through us. Now, look, MicroStrategy has been down the last few weeks, so it looks like, oh, that was a terrible decision. But I don't know which way MicroStrategy is going to
Mhm.
go, right? You want to have that on there, right? I'm sure I'll have oh, you didn't sell the calls far enough out. Because, of course, we all know MicroStrategy can go up 10% in a day.
Yeah.
Well, too hard to know which way that's going to go. So it is a really great utility adding in the call spreads. And I know that's
I
a little
agree.
complicated for some folks, but because somebody brought it up and wanted to know why we're doing it, hopefully that helps explain it. it is not, an options 101 exercise. There's a little bit of activity that and choice on when to roll those because you gave yourself literally options and choices within the position.
100%. So the next question was, what's going on with ULTY? And I'm not quite sure what that question means because I'm looking at the year-to-date P&L and ULTY is up 4.2%. NASDAQ QQQ is up 3.34, SPX up 2.9, IWM Russell 2000 up 1.2, and BIV down 0.15, NVIDIA down 2.35, and Microsoft down 2.96% on the year to date. So not quite sure what she means by what's going on with ULTY because it's outperforming like everything so far in 2025.
I thank you for Bill for giving the full picture. I appreciate that. You're right. It is outperforming the underlying indexes. So the ulti challenge is this: we are deliberately finding the most volatile tickers and selling options for income. Originally, when we launched the Ulti, that was the goal. Hey, just do covered calls on, the most volatile option chains you can find. Well, turns out they're volatile for a reason. We all know this, right? Because they have the propensity to go down. I just finished telling you that, in a covered call strategy, you still have stock risk. And so we were finding from time to time you'd have a minus 30, minus 40% performance on a stock after earnings. So we started adding in, these deeper out of the money puts for like random protection, right? And this morning was a good example where we were long Reddit and Reddit didn't do so great overnight last night. And we had long puts that eased the decline. Right now, I think it ended up rebounding, but I don't remember where it finished for the day. But my point is, we started adding in some additional tactics to reduce the volatility, but still bring in the premium. So more collars, maybe spreads. So that change occurred in October, I believe. The question I always get with Ulti is, hey, you're paying out so much, right? This 80, 90%, 100% distribution rate, you're causing the NAV to decline. But that's the rate at which we are selling the options, right? So we're going to distribute that always. So,
Mhm.
look, the total return to me is what matters the most to an investor,
Agreed.
not the change in the NAV. It's total return. So, look, I think the Ulti managers are doing a good job on outperforming the indexes. And we always look for more, but I think it's going fine.
No, I agree. I agree. And again, as former floor trader and market maker, I really feel that I appreciate what you guys are doing and just how lucky investors are to be able to tap into these kind of strategies. And again, I don't get anything for, no promotional fee coming in from
That's
YieldMax.
right. I'm not paying you to say that. You
You're
you
not
said
paying me
it
to
on
say
your
that.
own, and I appreciate it, by the way, very
Our
much.
clients have it. We're using them for our own clients, and we're using it for guys that want to use the cash distribution to buy Bitcoin. So we're using yield. We're,
Sure.
we're trying to we're trying to. The strategy was inspired by Michael Saylor, who is selling way out of the money call spreads, calls out of his convertible bonds, raising money for zero, and we're taking that premium that's collected. We're buying all the YieldMax ETFs, and with that income, we're buying spot Bitcoin ETFs. So we're trying to do what Michael Saylor is doing.
Yeah, I love it. Right, you're harvesting the premium out of the options market, right, and then using it to deploy into a different asset. It's great. I love
Next
it.
question from a old market maker site. So when a call that you're short goes deep in the money, does YieldMax have the flexibility of just buying an offsetting equivalent put to lock up that risk? And like how well are the market makers responding to a bid ask spread? Because they know you got to. Oh wait, no, you guys use flex options, so that's not even a thing.
Well, the calls are not flex, so you're not wrong. The puts are flex puts, so we use Euro style, so we can't get assigned early.
Got it.
But you're not wrong that we have the flexibility. So some funds, yes, LFGY, GPTY, ULT, ULTI have more flexibility in those portfolios. Whereas if you took a MicroStrat, MSTY, or TSLY or NVDY,
Mhm.
those don't have the ability. There's a few things we could do. You could always roll the call spread whenever we want to, right?
Mhm.
Um, if we're done earning time premium, we should roll it, right? We're gonna take action on it, right? It
Sure.
would be a weird scenario where we didn't. It's funny you brought up the whole put thing, right? So there are times where now all of a sudden you're basically neutral as stock because you're long the stock, You sold a call, it's way through the short call. And now you're kind of like, it doesn't matter if it goes up or down. All you're doing is waiting for some time to tick away.
Right.
Selling a put spread to regain bullish exposure and generate income is absolutely a tactic we will deploy from time to time in those situations.
Excellent. Excellent.
Yeah.
That's great. That's great. Um, Jay, I think that's really it for the questions. We answered everything that came inbound for our conversation. Is there anything you want to chat about before we bid you good night and thank you for your time?
Yeah, well, first I'll just say thank you for all the support and utilizing the funds, and I, appreciate your level of sophistication, and understanding how they work. So, Bill, hats off to you. Thank you so much for that. Look, I would tell folks, as I always say, understand what you're buying, understand that while these are, we call them yield max because yield is kind of the core characteristic of it. Again, understand the risk that you're taking. Understand that you're taking single stock risk when you buy a single issuer. Understand you're taking more like market risk when you buy a portfolio like ULTI or even some of our like maybe less aggressive distributions like BIGY, right? That's a targeted 12% income strategy, which is fun in the fact that we're going to give you more upside on that. We're going to limit the distribution, right? Kind of to the question as we started earlier. Hey, why don't you hold some of it back? In those
Right.
scenarios, we deliberately are geared more towards upside capture by
Mhm.
reducing the income.
Sure.
So think about how all of those are together. And the very last thing I'd say is I think the world is yet to really understand the inverses, which I think is also fairly unique. People understand covered calls, but they may not understand covered puts, right? So where you're bearish and selling it out of the money put for income, I would look. You never know what's going to hit in the marketplace and what's going to be popular. But our YQQQ ticker, which is the inverse Nasdaq, but still generating that target 15, 20, 25% yield, it's kind of a great holding as an offset, right, to reduce the volatility in your portfolio while still getting paid the high distribution rate. So,
Wait. I've never looked at YQQQ, although I've seen the ticker. Explain to me how that works. What's the
okay,
strategy
so
there?
we are synthetically short, long put, short call,
Long
right?
put,
So we're
short call. Okay.
bearish. And then below the market, we're selling a put for income. So as the market goes down, the fund is making money until it
Mhm.
hits its cap, which is that put that's below it. Exact same thing as a covered call, just flip it 180.
Gotcha.
And then we're distributing, and that's got like a distribution of 20%. So if you were, wanted to kind of create, you still like your income and you
Hmm.
wanted to reduce the volatility of your portfolio using a YQQQ is going to give you a little bit of an offset. Now, it's not a perfect offset, don't get me
Of
wrong,
course.
because if the market really tanks, it's capped, just like a covered call is capped. But it does still provide some distribution, right, in the form of dividends, and then but it has the inverse exposure. I think, by the way, of all of our inverses, that's the one I'm probably most disappointed that folks just haven't figured out how to utilize it in a portfolio
I
yet.
I can see it right now. I mean, in terms of again, Dorsey Wright is very big. They're a great educational platform for advisors, and they kind of give us this overall market supply and demand metrics that we take very seriously when the bullish percentage, NYSE BP turns negative, or it's in the
Sure.
column of O's, or maybe, things are spinning off. I could see how rather than just liquidating positions, potentially, if I am long YQQQ, they would give me an opportunity of giving like an something that's non-correlated to my portfolio and still collecting a little bit of income. So it's not like if I have to buy put options in my client accounts and we don't really hit it, they're upset because
You
we're
paid for a hedge.
I'm paying for a hedge that never paid off. So
Right.
I could see how a YQQ would be good when we're anticipating maybe a nice pullback or which and we get those every 2 years, right? We got it in 2022 going into the rate hikes, and maybe we'll probably see another one in the second year of this administration as the mid-year elections hit. There seems to be a pullback then. So
Yeah, I mean,
interesting.
look, it's you said it's not correlated. I would say it's inversely correlated to
It's
your
like
long
correlated, right?
holdings, right?
Hmm.
So I would say take a look at it during periods of market declines, and it's still kicking off its distribution, and it aims to generate positive returns in a down market.
Right.
So interesting. I'm
Right.
glad I got to show
Maybe
you something today,
when the
Bill.
VIX is
Thanks.
down to 12, we're going to buy this thing, right? Because we're
There
going.
you go.
Uh, all right, Jay. Listen,
Perfect.
thank you again so much for your time, and I'm just going to hit pause here and just say have a little sidebar conversation with you. Thanks again for your time.
You got it.